Good afternoon, everybody, and welcome to another edition of Chart Watch Live. My name is Capolingua. I'm from Market Index Live Markets, and it is a pleasure to be joining you on Wednesday lunchtimes to chat markets. And oh my gosh, what an incredible week it has been. Lows and highs, and somewhere, I don't know, in between today. Now we're going to talk about all of those things, plus get to your requests, the stocks that you want to talk about as well. I'll give you my best technical analysis reader. Hopefully some insights about how you can become a better trader as well, ultimately a better risk manager. A lot of today will be about risk management. And then hang around to the end. I'll show you how to get my trend ribbons for free. And if you're new to Chart Watch Live, you're gonna want those pretty soon. Okay, let's head over to the charts. And we'll kick off with our portfolio management model, starting with the Nasdaq. And this defines how much risk I can have on my US shares. Okay, so let's say I had $100,000 and I was investing $50,000 in the US, $50,000 in Australia, totally hypothetical. This would determine how much of that $50,000 I can risk in the US. And we have pretty much a traffic light system with my trend ribbons. When we've got double greens, it's all systems go. We can have up to 100% invested in stocks, zero cash, because when we're in a double green, low volatility uptrend, why would you want cash? Cash is burning a hole in your pocket. Get it invested, get it working for you. When we start to move to various shades of amber, we're not amber yet on the long-term trend ribbon, but amber in the short-term trend, down in the short-term trend, but still up. There's some confusion in the market. If there's some confusion in the market, why are we fully invested? So my model will step down, starts at about 2/3 risk position, 1/3 cash. It could be 50-50, which is where it is right now, or it could get to as much as 2/3 cash and only 1/3 invested or risk. It doesn't have to be invested, because as we're going to talk about in a second, that invested could be long or short risk as well. So we could be looking to take advantage of falling prices with our shorts. But for now, as I alluded to, 50-50. You might be saying, hey, why are we doing this US stuff, Carl? But what do I care about the Nasdaq? Tell me about BHP, Rio, and my 4 banks. Okay, well, we want to know what's going on here. It's a good place to start, because as we know, what happens in the US influences us here. When they sneeze, we get the cold. Short-term downtrend, it's clear as day. And this trend ribbon this short-term downtrend ribbon will tend to act as a zone of dynamic excess supply. Oh, that's a bit of jargon. It just means more often than not, it tends to push the price down. The price rallies up to the ribbon and gets pushed down. The price rallies up to the ribbon and gets pushed down. Why does it do that? I don't know. It just does. On the way up, and you can see when we break through the ribbon, it can be a little bit wonky, and that's news. That's information that we do want anyway. But on the way up, it tends to support the price. So on the way up, it supports the price. When it stops doing it, we've got some information. And when it starts to do the opposite, that's very important as well. Now, the long-term trend ribbon, it's a very similar thing, but in the long term. And you can see here how it tends to be supporting the price. And certainly since we've been engaging with that long-term trend ribbon, 1, 2, 3, I won't count them, but if you're reading my evening wraps, what are we at? 12 out of 15 of the last candles, in fact, 12 out of 16 with this one now, are white. And those white candles are telling us that there are pervasive buy orders in the market. There's a bit of buy the dip going on, and that buy the dip is somehow being sort of hit by that sell the rally, and we're getting stuck in the middle. So it's super interesting. Like, ladies and gentlemen, you will not, over here, this is boring. Double green, we love it, but it's boring. Now this is where it gets interesting, and I'm getting goosebumps just thinking about what could happen next, because let's go back all the way back to the GFC, the last calamitous decline. Of course, we had COVID as well. I've got some boxes there, actually, I'll talk about those in a second. But the possibilities are tantalising in terms of when we do start to get beneath that long-term trend ribbon, it starts to turn to amber. You can see what the short-term trend did there. Look, bad things can happen. So you can see here, the long-term trend ribbon supporting price. Carl, I don't like the sound of that. Why are you excited, mate? That's shocking to me. Well, because if you're a trader like me, a trend trader, it doesn't really matter which way the market's going. Up we go long, down we go short. And certainly I do have fond memories of the GFC and going short, actually doing really, really well. Now, I've got a question, and this is where I'm going to answer the first offline request from Julian. Julian says, it seems like the market is seesawing every day and the swings are big. I feel like if I was trying to follow the trend, I'd be rebalancing my portfolio every day. How do you follow the trend when the trend is extremely volatile? What a fantastic question. And this is why I'm back here. So we're seeing some volatility, but on screen, like we're seeing some volatility now, but on screen is the extreme, like one of the biggest downturns in the market's history. And Julian, if you have been watching Chart Watch Live, if you've been reading my evening wraps, you would know the answer to this question. And basically, the model will pull us out. So let's say, for example, this would have been the case. You can't go back and check the videos back then because I'd say, was it back then? YouTube, it might have only just posted its first video, and I certainly wasn't posting on YouTube back when that happened. But we would have been FRP or full risk position at that stage. And if you know my model, you would know that, once we start to do, and I just want to show you some of the price action. All right. Now, it's going to be a little bit messy, and I'm going to do it a bit quick just so I can make my point and move on. But certainly we moved into lower peaks, lower troughs. We had some pretty decent supply side candles here, and here we closed beneath the short-term trend ribbon. The short-term trend ribbon went amber. We went pink pretty shortly. We came back up to the ribbon. We didn't make it back above it. We threw in a pretty horrible candle. We did the same. I mean, I think if you know me well enough and long enough, you'll know that my commentary would have switched to a two-thirds RP very quickly. And then we would have gone probably half RP around here. And through here, we would have seen very little to no reason to do anything else. Okay. And then without a doubt, we would have gone to 1/3 RP here. And this is where I'm going to answer Julian's question. So we haven't picked a single stock. This is our benchmark. And if we were talking about the Australian market, which we're going to look at in about a minute and a half, we would have done a very similar thing at the start of one of the worst financial calamities to befall markets. We would have had 67% cash mandated, and as much as, we could have more than that, couldn't we? As much as 1/3 invested. We don't have to have the third, we could have less. And the obvious question, and this hopefully answers the first part of Julian's question, is, well, when markets get volatile, what do trend traders do? Trend traders get the hell out of markets. We don't sit there like sitting ducks or like heroes. I mean, I think the average mum and dad buy, hold, pray technique, right? Please God, please don't let the market crash, or please let it go back up to save my super. They're sitting ducks, but we don't sit around. We get the hell out. We move our money to cash. And here's the most important thing I'm going to say to you today, particularly in this environment, is that cash is not doing nothing. Double negative. Cash is doing something. Cash is a strategic decision that trend traders make, because while we're in that cash, it's earning 2, 3, 4%. Even back then, I think rates were pretty high. Might have been 3 or 4%. On an index that has a yield of maybe 1%, if that, we're doing pretty well. And if the index drops 50% like it did, well, our cash is now 50% more valuable than everybody else who just held on. Now the obvious question, so hopefully that answers your question, Julian. We don't hang around for the volatility, we get the hell out. Cash is a strategic decision. The next obvious question, which some of you are now asking, is, Carl, what's with the 1/3? Now, you knew the market was going to crash back in 2008, and you said, you just told me you went short and you made money. Why didn't you just go nuts and just short everything? Why couldn't you go FRP short? Okay, well, the first thing I say is, I don't know what the market's going to do anytime. I didn't know the market was going to crash in 2008. I don't know if it's going to crash now. Okay? Whatever happens, happens. I can't tell the bloody future, ladies and gentlemen, and if you thought I could, you've come to the wrong place. All I do is allocate my capital based on the probabilities that I see in the charts. Okay, so the charts carry with them, or chart patterns carry with them, and I teach you these chart patterns, a certain set of probabilities. And if the probabilities align with more often than not down, then I have to take the steps I've taken. Now, of that 1/3 RP, that is longs and shorts. This is so important. That's longs and shorts. I know it's counterintuitive, because you might say, why don't you just go 2/3 shorts and 1/3 longs? Because I've learnt, ladies and gentlemen, that in the worst of the worst markets, yes, they go down, but they don't go down in any sort of easily tradable way. And that's what these boxes are here to show you, is that the actual down move, yes, GFC, total wipeout, more than 50%, people's portfolios, pension savings, retirement dreams cut in half in the matter of about 23 or 24 months. But that down move happened in very, very short, acute phases. And this is why we're 1/3 risk, because for the vast majority of the time, we'll draw a different colour here. Hopefully it's starting to click for people why the model exists this way. Most of the time, the market was either going up or just really damn choppy, right? So it wasn't until there we started to interact with the long-term trend ribbon and have some confidence that we're coming out of that mess. This is why that 1/3 exists. It says, yes, you can go short and you can load up that 1/3 to short, but you can't go beyond it because the risk is you lose money on your shorts as well. This portfolio management model didn't just appear overnight. It has been developing over about 30 years. And I think it works pretty well. And I think the people who are using it now are starting to realise that also. Let's head over to thumbs up if that made sense to you. Surprise-faced emojis, because we don't have a thumbs down in Zoom. If that made no sense at all and you think it's absolute rubbish, let me know. Okay, good. We're on the right track. We haven't picked a single stock yet, ladies and gentlemen. Can you see why this is so darn important? Okay, now over to the ASX 200. And when you finish those thumbs up emojis or surprise-faced emojis, let's just go back here because we've been tracking this for a little while, both here in Chart Watch Live and in Evening Wrap. And here was the old Nasdaq going sideways, rolling over, but holding the dark green long-term uptrend ribbon. And here we were, not much more than a week ago, making a new high. Would any of you predicted that the old tin pot would have closed beneath its long-term uptrend ribbon before the Nasdaq? I mean, the Nasdaq was a whisker away from it's been a whisker away from doing it for about 3 weeks. And we go and make a new high, and then yet we break beneath it first. Ladies and gentlemen, I present to you the old tin pot. 4 bank stocks, a couple of resources, Telstra and Wesfarmers. Anyway, it is what it is. We still love the old tin pot. That's why we're here. But it also does demonstrate why you might think in terms of a global allocation model where you say, well, X amount is for the Aussie market. Here's my benchmark. X amount is for the US, maybe the UK. I don't know. South Korea's been going berserk. And you have the ability to do that now with the access we have to markets. You couldn't have potentially done it. It would have been harder to do it back in the GFC. Certainly harder to do it 10 years before that. What do we make of the old tin pot? I note that yesterday it went, look at that long-term trend ribbon, went amber for 1 trading session, ladies and gentlemen. This is volatility. I can't even recall when the long-term trend ribbon went amber just for 1 session. Something big is going on. And to reiterate, I'm at half RP and I can't be any more than that. And if you see in this chart a reason to absolutely load up on risk, then full credit to you, go for it. And I wish you the best. And I hope the market goes up, makes a new high by next Monday, and it all turns out well. For me though, I say, look, it's just not worth it right now. It's not worth my headaches. It's not worth the risk of what we saw in the Nasdaq, that GFC. So I'm just going to call it. But you do whatever you want to do. This is not about what you should do at all. This is about what I'm doing, and you can decide whether you want to come along for the ride. Let us head over to the TradingView screen now, which I'm guessing many of you have access to. I just want to talk about crude oil, because obviously it's part of the reason why we're in this mess. And this candle here coincides with that wild swing on the ASX 200, which crack the long-term uptrend ribbon. So potentially, if we can understand what might be happening here, we can get a better read on our risk allocation, both in Australia and in the US. Let's put this into perspective. Let's head back maybe to a weekly chart. To start off with, I'll just get the default zoom going. We can see a peak here. That was in early 2022, and that was immediately after Russia's invasion of Ukraine. So we can see the last time oil had a similar sort of spike was due to a war, unfortunately. And it tends to be the case with this commodity, isn't it? This one, interestingly, is a little bit closer to home. Obviously, Russia is a big global supplier of oil, and the fear back then was that when sanctions were going to be put on Russia, as they were, that would negatively impact global oil supply, and up we go. Now we're in the Middle East, and I just want to give you some perspective. Here we are with a war in the Middle East. The Strait of Hormuz is closed, effectively, and we actually haven't so far seen as big a response, and certainly to this week's candle is showing a big upward shadow. And what do you notice about this week's candle and the candle that ultimately spelt the cycle high of that last war-induced run in crude oil? Now, I must stress that this week's candle isn't closed. Today's Wednesday. We've still got a lot of Wednesday to go in terms of Northern Hemisphere markets, Thursday and Friday. And Friday we'll get a close. So we'll see how it goes. But again, can I reiterate how similar that candle is to that candle? And history doesn't repeat, but it does rhyme. And because these candles are telling us that what the balance is, the battle between demand and supply. So if markets were really, really worried about these things, we wouldn't see a candle like that. We'd see a big white candle, high close. This candle's not closed. But I just want to bring that to your attention. If we go back to the monthly chart, I think from my tone last week, you probably would have got that it's got my attention, that something interesting is going on, but I'm not certain, I wasn't certain at last week's stage whether it's the big one. And even then, if you look at what happened back here, this was the last run. Well, actually, this was probably global recovery as well. China really stimulated post GFC, and that would have helped this one. And then obviously the first quote unquote miracle of Chinese growth before the GFC this time as well. And these were less about supply shocks and more about just robust demand. This one's certainly a supply shock. And we can see how volatile oil is. And that should also give you a hint that, well, oil is volatile up and it is volatile down as well. And then unfortunately, I can't go back to, that'd be the first Gulf War. Well, there you go, back there in 1990. So, and that's a proper spike as well, because if we look at this in percentage terms, actually that's how we should be looking at it. We should have been looking at this from the start. We can see that the first Gulf War induced a much bigger move in oil prices, as did what happened with Russia and Ukraine. And then we've just got the demand side bull markets as well. So where does this one sit? I can't say yet. It hasn't, I still need a bit more information. I'd love to see the end of this week's candle, maybe even one more after that to either confirm or deny, and then I'll have a better idea. And that's why you tune in, isn't it? Hopefully for what you agree is some really sensible and unemotional analysis about this stuff, which you can get from the chart and you can't get from the media, because they're going to tell you it's the end of the world every day, even when nothing's happening. So let us continue to monitor this situation. Now we have to go to your portfolios and see how this volatility has impacted your portfolios with your portfolio requests. So let's head back to here. And this is the frightening bit, isn't it? Where we get to see how some of these things have played out. I did have only a couple of offlines. James has got ODY, and then we'll get to your online requests. And I don't do all the offline requests, don't worry. I don't think offline requests get a better access to this than you do. I select ones which I think are pretty interesting, and I like this chart. So the question and it had a little bit more to it. James was asking about this point of supply. That's why I thought this was a really interesting question. He said yesterday's candle, and that's the one there. I put it in as a feature chart. So I think we can all get to the conclusion that it's plus R. And we'll head up here. I just want to draw in the price action because this is what you need to do at the end of the day. This is, yesterday I didn't have today's candle, so that's where we were. And I want to check the price action. Do I have rising peaks and rising troughs? I know I've skipped past this part, but you've done that part already. You've gone double green. Okay, that's the beauty of those moving average, that quick assessment of the short and long-term trend. It takes a little bit longer to delve into the price action, but I think candlesticks are probably in alignment with these colours, aren't they? It's pretty easy to see lots of whites or lots of blacks. And yes, there are blacks around the place, but generally when there are whites, it usually does pretty good. And then the selling comes in. For me, it's more in a lots of whites phase than a lots of blacks phase. And the question from James is not so much why I put it in. I think we all agree that if we have to make a decision on this day here, and we've always got three options, equals R, which is if we had it, do nothing, or if we don't have it, do nothing, I guess. Well, I guess that wouldn't be. There's probably just abstain. I don't know. I won't make another R acronym for that. But we know we've got plus R and we've got minus R as well. And we've got to pick one, essentially. So we know we had a tick for plus R. Okay. The question is, well, why did this deserve to be put on a higher pegging than some of the other charts identified in ChartWatch ASX scans? If you have no idea what I'm talking about the daily lists I produce for you on Market Index. They're over here, ChartWatch ASX scans, where I curate a list of my favourite uptrends and then the feature ones that come out of that. I think they're the best within that list. And my favourite downtrends. You can see the downtrends list is a bit longer, and then my favourite downtrends as well. And just a sample of the charts that accompany them. So this one was in yesterday's, this morning's report based upon yesterday's candle. And finally, here I get to James's question, which is, hey, Carl, there was some supply up there. I might just peg that and that. So at the top of this candle, the top of this candle, because the supply started here and it continued there the next day. You can draw this red box anywhere you like. It really won't matter. But that's ultimately, not only is this a point of supply here, well, it's actually a major point of supply. We can see that we have the rising peaks and troughs on this side and the falling peaks and troughs on that side, which defines this as a major point of supply. If you're new to ChartWatch Live, go watch the old videos because we talk about exactly these things. And we've talked about in the past also this idea that we don't have to wait for the break of the point of supply. We just need to be confident that it's weak enough that the break is more often than not going to occur. And that's a little bit of a leap of faith. Most technical analysis books you're going to read will say, hey, wait till the break. I guess you can't be any more certain that the point of supply has been dealt with than if you've traded above it. I was going to say I don't like to do that. That's too strong a word. I just don't think it's necessary. I think if we can hit the level with a candle that is so emphatic of demand side control, that the demand side is rock and roll, meaning business, that we don't need to wait for that. And that's the way I viewed yesterday's candle. Above average volume, might say, well, Carl, it's got less volume than that one. Well, this day here, actually, no, that is the one, sorry, because I got mixed up with that's today's volume. And today's not even finished, and yet we're seeing some decent volume. So we are seeing, increased volume in this scenario. What does it mean? Well, increased volume always means increased interest. Always. If you've got lots of volume, it's lots of buying and lots of selling. Lots of buying and lots of selling by definition is increased interest. And you need eyes on screen for something to go up. You also, you don't always need eyes on screen for something to go down, but it certainly helps in these small stocks for eyes on screen, bums on seats. The more traders looking at this, the more likely it is for them to get excited about whatever news is driving this. And I wouldn't have a clue what the news is, and I don't care. So above volume today. But yesterday was the candle that I felt was emphatic enough with its huge white body. And how do I know it's huge? Because everything's relative. Well, I go to my optimized true range. You can use ATR1. Mine's optimized. I think mine's better than Wells Wilder's version. No, I don't share that one. But yours will do something very similar. Yes, it's double the average. So something big is going on. It's not subjective anymore, it's objective. Something big is happening in volume. It's not subjective, it's objective because I've got my volume here. Okay, it's massive. It's way above average, multiple times. So there is a substantial amount of demand being driven. There's a demand frenzy, but there's still supply. Okay, volume is buying and selling. So a lot of people say you want your stock to go up on lots of volume, which I'm not so sure about that, because if there's lots of volume, there's a lot of people that want to get the hell out of your stock. That's not always a good thing. Right? So there are times where you actually don't want to see high volume. This isn't one of them. You do want to see high volume. You do want to see a large amount of supply. Why? Because we're dealing with a point of supply. And hopefully this is the clearest explanation of when volume matters and when it doesn't. There are a few different scenarios we talk about here in ChartWatch Live. This is just one of them. Point of supply equals massive latent supply in this area. Right, in brackets, I can keep going, X post regret. All right, it's people who last time on the way up, they were very much, here we go, here we go, here we go. Odyssey Minerals is going, not 10 cents, it's going to $10, mate. Here we go, here we go, here we go, buying like crazy. This thing's going to be a monster. And then they don't get out here. Don't worry, it's just a pullback. It's just a pullback. It's been going up. It's fine. Oh, I'm not so sure about that. Well, I can't get out now. right? I can't get out now because, it was 4.6. Now it's, 3.6. Why would I? I'm not going to get out 3.6. I'll wait till it goes back up to 4.6. Look, I know I should have got out at the last high. I deserve the high. I deserve, for my hard work of holding this long, I deserve to get the high. So I'll wait till it goes back to 4.6. As soon as it gets to 4.6, I'm out of there, right? Which is so stupid when you think about it. Because number one, it might not get there. Number two, if it gets back to 4.6, you don't want to be selling. You want to be freaking holding because it's got back to 4.6. It's probably going to keep going. Anyway, I know most of you at some stage before you met me thought the opposite of what actually you should be doing. But anyway, now you know. And a few people are going, yeah, Carl, you just explained my exact method for trading small stocks. Okay, so now it gets down to here, all right? It's down to here, and you go, oh, shit, man, why didn't I just get out at 3.6? Look, now here you're going, look, This was a long-term, this was a long-term one because it's got good fundamentals. It's digging in all the right places. I'm just going to hang on. Look, I'll just whack this one in the bottom drawer. Oh, there's quite a, that bottom drawer's pretty full. Now let me just, okay. Yep, that one will just sit in the bottom drawer for a while. But I'll tell you what, if I can get break even ever in the history of mankind, I'm out of there. And not everybody who got stuck in here is going to think like that, but some people will. And there is ex post regret. There is latent supply, and we must deal with it, which gets me back to here, which is how we need to understand what that volume means. Lots of demand, yes, we love lots of demand. Lots of interest, yes, we love lots of interest, but lots of supply, ba-boom. Okay, but it's not so bad in this scenario. In this particular scenario, we don't mind that lots of supply because we need to trade with them. They've got stock. They don't believe it, or they just want to get the hell out. We need to give them cash, right? Is there lots of cash around? Yep, I can see that. That's good. Tick. Now, this is the beauty of it, and this is why I don't have to wait for the breakout, and this is why the breakout is a thing in technical analysis books, is once we clear out this latent supply, by definition, that means giving them cash for their shares. So they're not in shares anymore, okay? They are short shares and long cash. When the breakout occurs, as so often is the case, I mean, breakouts are a thing in markets, whether technical analysis defines them or not, I don't know, but they are a thing. When the stock gets to 5 cents, right, up here, or 5.5 or whatever it is, everybody who then sold down here is going, oh, I knew I shouldn't have got out. Oh, man, I waited so long just to break even and now I would have been up 20%. Oh, and look at the news that just come out. The news is amazing. I knew this was the one I was going to take me to $1 million in my first trade. I have to get back into this thing. There's no way this thing's going to get to $1 million without me being on it. All right, where do I buy it? Now, some of them will get straight back in. Some of them will say, well, I can't buy it now. But if it gets back to where I got out at 4.6, that's where I'll buy it. Right? So what we find is that if the price, it doesn't always, but if the price after it breaks out should pull back, and it, we'll see from volume, we'll see from other things, we'll see from price action, but the more people want it, the shallower that pullback will be. And we'll tend to find that this historic area of supply no longer behaves as a supply zone. This is why old zones of supply in the future begin to act as zones of demand. Okay, and note I'm not using the most two stupid words in technical analysis, which is support and resistance. But what's support, what's resistance? But when we talk about a zone of latent supply, of excess supply, when we talk about a zone of latent demand, of excess demand, now those words are starting to mean something. So hopefully, James, that explains why I was brave enough, and it is a brave call to go pre-break of a major point of supply than that, but I had evidence to suggest, in my view, and it's just my view, it's just my experience, that's what you're getting. My MOTNs, my lists, my experience. MOTN, the price tends to get through. And the beauty of it is I'm in before the breakout traders. The breakout traders are now helping my trade. Okay, let's get to your online requests. I know it's frustrating for some people who don't get their question answered every week, but hopefully there's enough good stuff along the way to make it worth your while. Let's start from the bottom this week and work our way to the top. Michael, a follow-up question here. What if it's a false breakout? If it's a false breakout, then I may well lose money. But the good news is, Michael, is that I'm in a bit earlier than everybody else who gets in up here, aren't they? And well, actually, I couldn't have asked for a better segue, could I? So that's the kind of the benefit of being earlier, but not so early. So I think I did plus R, to be fair. I'm pretty sure I put a plus R on that day, right? So it was in the list that day, but it wasn't a feature on that day because I felt it wasn't close enough yet. Like great supply removal, great candle. So plus R, but was it a feature? The features are the ones that I would look. I'm happy to put them all. I'm happy to do them all, but I can't do them all. The features are more the ones that I would focus on for my own personal plus R. But that doesn't mean other people don't want to see the fuller list anyway, because they might be holding it and they're just happy to know that on that day, Odyssey was still a plus R. That Carl said it was still plus R, and there's value in that for them. So I'm going to put the big list, and then I try and narrow it down. And just because I narrow it down to the feature list doesn't mean they're always the best, You might say more often than not they tend to be, but it's not always the case. But the good news for you, Michael, is asking what if it's a false breakout? We tend to be in before the breakout. So if we tend to get a signal, you've got to think the candles are occurring up here, right? The reversal candles that we use, the big upward shadow on high volume blowout, the big black candle that might follow it, those are coming in, hopefully, usually, above our entry because we're in before the breakout, and we can usually, implement an exit, at least a partial exit, before we get to our entry, and hopefully, a break even or not much worse. And we're going to have false breakouts. So the first part, I think, hopefully you agree, the first part of my question, my instant response was, well, if it's a false breakout, we might lose money. Okay, that's part and parcel of trading, whether you're doing it by technicals or fundamentals. The second part of it is, well, we've got a little bit of an advantage in that regard as well. Okay, let's go to May, who's got DYL, Deep Yellow, and this, I'm so glad we've come here next, like, best place to come, because we're going to see a theme in today's presentation of charts that looked perfectly holdable, perfectly equals R, in some cases even plus R, and yet they've completely unraveled. Okay, and this gets back to Michael's comment, well, when that happens, we lose money. As trend traders, we lose money. We can't tell the future. We didn't know that the US and Israel are going to start bombing Iran, and we didn't know Iran was going to bomb everybody around them. Okay, welcome to the world we live in. When that occurs, trend traders are going to lose money because volatility is going to get them. So we're going to see charts that were, on that day, I think very much equals R. I'd have a crack on that day. I'd have a cheeky little crack on that day. Nice little double bottom, short-term trend ribbon, good little push off, a little bit of volume on this one. But that's where I'd have a cheeky little plus R. I'm pretty sure I put in that day, didn't make feature. All right. So let's say I got in on that day. This is where you last asked me about it. That's why it's got equals R or plus, in fact, here. In fact, last week I did say plus R. Okay. So this candle would not have existed because there's no way I can put a plus R on that candle. So you would have asked me about it on this day. It doesn't matter. It doesn't matter. Even if that's your equals R, a plus R day, right? We still didn't get a lot of warning because that's still plus R. Oh, sorry. That's still equals R. Let me copy and paste that over. On that day there, we wouldn't have gone plus R. Too much of a black body, but certainly equals R. And that's my point. And then we go here. It's like, okay, well, what the hell just happened? We know what happened. So what do? Well, we just do our work, analyze, accept the outcome, act, which is manage our risk. So we know that this is a point of demand. Okay, why is it a point of demand? Well, was the price bounce from there? Okay, we went from setting lower highs and lower lows to higher highs and higher lows. The only way you can get that sort of a bounce is if there's demand there. Okay, we know that this is a point of demand for the same reason. Okay, so we've got 2 points of demand. This is where the buying is. This is where the market is buying the dip. It's being supported by the short-term uptrend ribbon. The dips, they're buying at higher levels from the last dip. It's all hunky-dory. The bottom line is there's demand down here. They're buying. It's the same buying from here. I guarantee it. The same buyers here, we're buying here, and they're buying here. Right? They're probably the ones that drove this. They're probably the ones that sold a few here to knock out some supply, buy the dip, knock out the short-term trades. It was getting hot here, $3. Let's knock a few out, right? they're in from way lower levels. Let's sell a few and let's create a little bit of a pullback here. All right, that's enough. Let's start buying again. Now, on this day here, what can we say about that demand? I mean, surely it's not a good thing. Surely all of that buying now is under threat. The demand is under threat, and there's probably some supply in the system now, if not even from the same people. They've switched sides to warrant some concern. I mean, you see a candle like that, what do? It's not the worst candle, but it is beneath 2 points of demand. So how do we deal with it? For me, I think this is commensurate. I think this is appropriate. Minus a third, which is what I like to do. But we normally say minus R because I want to keep things nice and simple. But yes, we also know that if we had 1,000 share model, and it's a pure template model, I like to do my business in thirds. And even then, what's a third? Because I've got this cheeky little 100 that sometimes I like to keep. Not always. Sometimes I like to keep. That last little 100 might go with the last lot. Okay, so this is not news. This is stuff you already know. So minus R. I see that, I go minus R. Don't ask questions. I see that, how I feel. Is this encouraging me to maintain my risk? Or is this suggesting, and we know what's happening in the world, maybe I should just play it safe, right? You heard me say as early as Wednesday last week, so a week ago, before the big hit we had, where I said, well, and I actually am going to give myself a little pat on the back for as early as that, saying, I think the time for adding risk is past. I think we want to just not add new risk and just let risk roll off. And some people get confused with that idea of just letting risk roll off. And this is what it means to let risk roll off. Obviously, we're not taking new trades, but we're being really attentive, and you could even say aggressive, about applying the model here and taking risk off the table. So what have we done so far? We've kind of done that. And at this point, we've kind of done this, right? And we've got these two left. And we could be thinking about, well, Deep Yellow, it's a good company. It's got great operations. The uranium price is probably going to go up because the oil price is going up. Historically it has. There's great correlation. We could be thinking of those things, or we could just be responding to what is happening. And we're not happy here, right? This is not good. This is disappointing. But we're also pretty relieved as well. And I think this is probably now where we all agree we go here. And are we keeping that final little kicker? Well, not given we're trying to just let risk roll off. So I think at that stage we're ZRP. Okay, and here we are now. Now, for the person who asked this question, May might be thinking, and I don't know, it's purely hypothetical, might be thinking, shit, Carl, I didn't do any of that, mate. I didn't do any of those minus Rs, mate. I got the whole lot. What the hell am I supposed to do? First thing I said, well, mate, if you're tuning in every Wednesday, and I know you do, I know you're regular, I know this is purely hypothetical, I'll be saying, well, I'm teaching it to you. Maybe you might want to start using it. The second thing I'll say is, well, we just do the analysis, right? Much like we did before, or didn't do before. And we say, well, who's in control of the price? Is the demand side in control of the price? Is the supply side in control of the price? And I think it's pretty obvious that it's not the demand side. You could argue, well, it's not quite the supply side yet. The long-term trend ribbon is doing its job. Can you see, lower shadow, it's just somehow this long-term trend ribbon is just somehow doing its job. I don't know how a variable automatic transition to CVT, what's the first thing? What's the first C sound? I don't even know. I don't know how it works, but my car's got one and I can drive my car. I don't know why the long-term uptrend does what it does, but it does. And so the only question mark for me would be whether, you'd retain that in this scenario. And I think we all agree, what's the point? Now, I don't know where it's going next, May. It could do this. I don't know. I wouldn't have a clue. But for fear of it doing that, I'm still ZRP. Okay? We analyse, we accept, and that's the hardest part, isn't it? Analyse is easy. You can all analyse now. The accepting is the hard part. Once you accept, I think the act is the easy bit. Some people say, no, acting's hard, Carl. Acting. I can't actually get to my computer and make myself do it. Well, you can if you've accepted it. right? Isn't accept weird? It's weird why it's in there. Analyze, oh yeah, tech candles and da-da-da. Act, go to your broking platform. What the hell is this accept part about? Why is that one of Carl's 3 critical steps? I think we understand why, particularly in markets like now. Okay, let's go to VEU, which we're going to see these charts, aren't we? Perfectly fine. Happy to plus risk equals risk. Happy. No complaints. Is that enough warning to do something? No. For me, no. On that day, happy holder. No complaints from me at all. Oh. And that's literally the response. I mean, I write about markets all day, so I would know this. But let's say I was checking my markets checking my portfolio after the market closed. I come in, I see that. That's a very much me response. It's like, oh, and that's not what I was expecting. Okay, let's do the analysis. Let's act. Well, we're beneath here. That's a point of demand. So hopefully you agree that these are now things that I'm pointing out that we cannot deny. These are things I've taught you. They exist. They're easy to define. Short-term trend ribbon, 2 big black candles. If you blend these 2 candles together, I mean, let's pretend this little one in here. Let's zoom in. Let's pretend this little one wasn't there. If we had this one, and this one, if you go and get a book on technical analysis, they're called 3 black crows, which equals bad, right? But are they 3 black crows, or are they just really, if you blend them together? So if you squeeze these 3 candles into one candle that ultimately opened here, because that's the open of the 3 candles, that's the close of the 3 candles, and we've got the high and the low in between, you get one big black candle, right? Which is when you hear me talk about major demand or supply side candles can look like 2 things. So if you read any of my work, you know that I always say big black bodies, yeah, or long upward pointing shadows. They're the only 2 things I'm focused on when it comes to reading candlesticks. The size of the body, big black body, or upward pointing shadow. And both of those, I call them my supply side buddies, or my supply control buddies, right? So the 2 work together to give me incredibly good information about the supply side coming in and taking control. Is that fair to say? The first candle is because the first candle was white at one stage. Think about that. That'll blow your mind. This first candle started white. It has to be that way, ladies and gentlemen. I know if you're not familiar with candles, you're going to watch this in the recording and you're thinking, why did he say that? Why did that start white? ChatGPT, Carl said this, what? It started white, but it finished like this. So this is the supply side coming in to take control, and this is the supply side in control, right? They're really in control. So if we blend these 3 candles together, so for me, there's not 226 candlestick patterns, there's 2. They will blend into taking control and got control. White or black, you work it out. So here, that's another big issue, right? Blend these 3 candles together. It's getting harder and harder for me to make a case to continue to hold risk. So we add them together beneath a short-term trend ribbon. So if we were to define now the minus R elements, well, there's one there. We'll put one there. The candles, the big black candles, copy paste, and well, leave that one there. We'll just put that. So black candles, close beneath the short-term trend ribbon. That's the one I haven't addressed yet. Minus R, minus R, minus R. Okay. Now, is this, I think that's pretty obvious, but is this one of those situations where you might do the cheeky 100? And I don't mind it. I don't mind it. Remember, that cheeky 100 is there to respect the long-term trend. And we still had a decent long-term trend at that stage. Now, we would have been pretty disappointed that we did that, but really it's only 100 shares. I think we would have been more disappointed if the price miraculously did this and we didn't have 100 shares. And this is kind of the beauty of this 100 share model. I don't know if I've talked about this. Why is this, I call it my cheeky little 100 shares. And again, this is about the accept, because if I went to minus, and this is just a template, minus 900 of 1,000 shares by this day here, right? So this day here, minus, and it went back up. Like, my model requires me to start to consider it for adding risk again. right? And the psychology of that is mind-blowing. It's like, let's say it's 117 and I just got out down here at exact low. I'm less likely to accept it. I'm less likely to act upon it because it's like, I can't get it. I'm so scared that if I get back in here, it's just going to go straight back down again. I'm going to lose again on this thing. I can't let that happen to myself. So I'm going to look for something else to trade. And yet on that day, for whatever reason, it's the best thing to trade. And over the next 6 weeks, it turns out to be the best thing. If I'd got all out at that stage, that's very hard to do. Even somebody of my level of experience and discipline, right? And I'm usually pretty good. So that 100 shares helps me because if it goes back up and I've still got those 100 shares, I don't feel so bad. It's like I'm annoyed. I'm really annoyed, but it's like, okay, it's not so bad. I kept that 100, pretty happy with that. Can I get back into this thing? Yeah, I can. Yeah, I can. So a lot of the stuff that's built into this model is not just black and white candles. It's there to help me be able to accept and act. What do we do now? I don't know if I need to spend a lot of time on the what do we do now in many of these, because I think, if we're honest about things, we're here. And we're just protecting our capital by having it not in the market and waiting to see what the trend will be, and then we'll happily apply that capital. 4DX is an interesting one. It is actual. God, we've done some analysis on this in the past. Let's get rid of all that stuff and start fresh. I definitely put this in yesterday as plus R. I think that's pretty obvious. We've got a nice short-term uptrend, long-term uptrend. The price action is rising peaks and rising troughs. So I won't draw it in, but it is. And then we had a really decent candle yesterday. Volume's about average, but in a terrible market, it's holding up really, really well. You'd see that on the relative strength comparative. So this is comparing the performance of 4DX versus the market. You can see it's beating the market, hands down. So, yeah, happy to plus R on this one. As of yesterday, today's candle doesn't warrant it, right? So certainly equals R today. I can go plus R on the next demand side candle. So I've just explained to you what supply side candles are. The demand side candles are the opposite. They are the downward pointing shadow or the white body. So either of those, there's only two things to look for. There's your white body one and a downward pointing shadow one would look like that. So if I see either that pattern or that pattern, then I'd happily add risk. Today's candle is a bit different. It's actually got the upward pointing shadow. Now, Carl, upward pointing shadow, better get the hell out, mate. Well, you can do it if you want, but for me, in terms of order of magnitude, that is a very small supply side showing against what is otherwise, quite a convincing demand side market. So no, equals R plus R for me on 4DX. But we also know as well that somewhere up here, we're going to have some supply to deal with, and we'll do that when we get there. This is probably about the last place in terms of price that I could get in. If it starts to get closer, and this is a bit of a caveat on that next demand side candle, I've definitely mentioned this to you before. If we're getting in here, right? So if we're getting around this level, and my first minus R point is down here, and hopefully that's all just self-evident to people that this is my first minus R point, right? So if I'm defining what my risk is and I have an understanding of what my reward is, I need to make sure that this distance here is smaller than this distance here, right? And don't worry about where I've drawn that. It's the top that I'm most concerned about. So up to here, all right, versus here. We can see we've got more reward than risk, so I can do the trade. That's all I need, 1-to-1 or better. A lot of you'll see a lot of so-called experts that will say, oh, you have to have 2-to-1 or 3-to-1, don't do the trade. Yeah, man, I don't know what's going to happen next. Like if you're saying, and then they'll get out at 2-to-1, or then they'll get out at 3-to-1. It's like, well, man, what do you think you know what's going to happen? I don't know what's going to happen. Let me just get at least 1-to-1, and then let me see what happens when I get there. Because who's to say it's going to stop there? It might just keep going. It might go to $10. Why would I limit myself to 2 or 3? Well, I don't know yet. I'll let the candles tell me what I need to do. I don't like that sort of stuff. Oh, let's get 2-to-1 or 3-to-1. Or you have to have at least that. No. I need to have 1-to-1 because why would I risk more than I stand to make? Okay, but let me see how it goes when I get there. Let's go to, we'll do a few more today. We're getting pretty close on time. PME, well, of course we should do PME, shouldn't we? We were equals R. Even then, I don't know why you'd be equals R on that day. Maybe I just didn't cross it out. And I think that's probably more likely what happened. Because in my heart of hearts, I can't get to equals R on that day. It just doesn't make any sense for me to say that. Does it? Like, why would I say that? So yeah, I'm going to say, go check the tape. Somebody will let me know if I said it wrong. But I probably just forgot to cross out the equals R at that stage. Funnily enough, equals R has turned out to be probably the right thing. Not probably, it's higher than what it was, marginally, a little bit. So equals R has turned out to be the right thing to do, and minus R hasn't been the right thing to do. If you minus R on that day, you're going, oh, well, it's higher. Well, how much higher is it? Who cares? It's not that much higher. Better things to do with my risk than take the risk on this one, because the risk is still, I think, quite substantial. Short-term downtrend, long-term downtrend. The short-term trend ribbon has done a pretty good job, actually, hasn't it, of impeding upward price action. So I don't think I want to muck around with it here. Now, if it gets above the short-term trend ribbon, that's what I actually could get to equals R. Like, yeah, okay, it's no longer a get out proposition. It's a hold and see what happens proposition. But it's not quite there. It's not far away. I mean, there are some things here that are actually looking half decent for equals R, which is rising peaks and rising troughs. That's a tick. Okay. A predominance of white candles would tell me that we have switched from pervasive sell orders to actually some demand, side interaction, some accumulation, perhaps. I think it's more short covering than anything else. The volume has been substantial through here, which, it's consistent with more activity. So no activity through here, right? Why was there no activity through here? Can anybody come up with an answer? No activity through here. Why? Think about the shorts. Think about the buying as well. It's the same people shorting that weren't buying. Have you heard this, the most silliest thing you read in technical analysis books, or people who think they're experts in technical analysis? They say, if your stock is going down on not much volume, that's okay. Think about it. If your stock's going down on not much volume, you're in deep poop, because it means there's nobody wants to buy it. So it's going down, which means there's excess supply, but there's no volume, which means that supply is desperate to get out. Can't find any buyers. Buyers are running away in terms of price. That's why the price is going down. But then the volume comes in. Okay, so all this time, that the experts were saying, Medicus is a great stock, great growth story, incredible, SaaS, place to be. And then they realised, well, it's just what do we call it? A valuation re-rate, or whatever it is, a multiple re-rate. And then we're saying, well, it's starting to be good value now. Now, what the market's doing is shorting the hell out of it, right? That's why there's no volume. But what is the market doing now? Like, to get out of your shorts, you need to buy. There's still a lot of selling, though. You can see from the volume, there's lots of selling, because a lot of the fund managers, the index funds, they have to de-weight. As the stock plummets, they have to de-weight the stock. So they're still selling. Amazing, isn't it? They held all the way through, and now they're selling. And you don't think the fund managers know this? Like, this is their playbook. This is their playbook. Stock probably shouldn't be where it is. It probably should be half. Let's sell it, tip the balance, tip the momentum, get all the momentum traders into this to short the hell out of it, right? Then the passive funds, remember, the passive funds, right, that just buy based on index weightings, 80% of Australia's superannuation is in this because it's the default option. We don't choose. Or you've got a choice. We don't choose. We just pick the balance fund, the default option. So those funds now have to start to de-weight. And guess what the short sellers do? Because they want to take profits now, right? So that de-weighting supply is great for these short sellers, because they can cover back their shorts. And that's what this influx of volume, I think, is telling us here. Does that mean we should run out and buy it? I don't know. I wouldn't have a clue. But I can tell you, if it starts to do the right things based upon my model, that's when I could start to get interested in it. So I want to see it close back above the short-term trend ribbon. I want to see that short-term trend ribbon change colour. It's not rocket science. I want to see this do this. All right. And when you see that start to happen here, that's when I'm going to get interested in PME. Okay. You've got to understand you're a very, very small fish in a very, very big pond, ladies and gentlemen. Let's go to Anonymous. I don't answer questions from Anonymous. Put your name in next time. EBO. Spend 3 seconds on this. Unless, this is from Steve. Wasn't able to do before. Can we do EBO? I don't know. Maybe Steve short this. So for me, this can only be one thing. Lower peaks, lower troughs, predominance of supply side candles. This is actually really interesting. Yeah, oh, wow. I'm getting goosebumps. To go from the last one to this one. Hopefully now, it's like, you know those, remember those 3D puzzles? Like you look at them, they're showing my age now, those 3D puzzles all the rage. You look at them and you can't see. And then somebody says, no, you have to look past the surface, right? You've got to look about a foot past and then you'll see it. And it's like, now I can see everything. That's what Chart Watch Live is, ladies and gentlemen. All right, so now look a foot past the screen, because what's happening with the volume here? Have the shorts started to come in to cover back on this one? They haven't, have they? What are the candles doing? Have we seen those cluster of white candles? We've seen those rising peaks and rising troughs we saw on Pro Medicus? No, this is still pervasive sell. Those black candles are sell. They're algorithms. Is there demand? No, there's no demand. Go, sell at a lower price. Hit the demand there. We've soaked up all that demand. There's no demand left. Go to a lower price. Working day in, 6 hours a day, 6 hours a day, 6 hours a day. Now, I can't tell you what to do with EBO because what you do is up to you. I don't care. But equals are, let's take plus R. I think this is what I did with Pro Medicus, isn't it? I took plus R off the table. I think that makes sense. Let's take plus R off the table, and then what do we do? Okay? I can't even get to here, and I think that's what I meant to do with Pro Medicus. So I can only be one thing, minus R. Now, if you run out, if you own EBO and you go, oh, that doesn't sound good, and you sell it and tomorrow it does this, I don't know what's going to happen next, ladies and gentlemen. If this gets taken over tomorrow at $32, so be it. Is it possible? Yes. Is it more likely to happen than not? No, I don't think so. I think more likely this will keep going down. And that's how I trade, based solely on probabilities. And if I lose, I lose. I take my loss, I get on with it. Let's do, oh man, we've got the same stuff coming up every time. Xero, actually Xero might be 3 candles ahead of Pro Medicus in terms of what's happening here, isn't it? And this is why I'm so cautious with trying to buy the dip on these. I need more evidence. I need more proof that the demand side, it's not just short covering anymore. Actually, we've got positional buying, long-term value-based buying. It's hard to have value-based buying when you're still trading at probably 60 times earnings, isn't it? So that'll be the question mark, I think, for Pro Medicus and many of these things. Look at 20 times, 25, 30, maybe even 40 times. Then you could really argue they're cheap. But if they're still 60 or whatever, I don't know what they are. I think Pro Medicus is still 70 times. It's hard to say that the value funds are really coming in en masse. Certainly, we're seeing short covering. And I think that's what we're seeing here. We're seeing a short covering interaction. You can see price, low volume, bit of interesting stuff here, but generally low volume is it falling. Is it fair to say you've looked past the surface of the page now, you're seeing the 3D picture, that price falling on low volume is not okay. That's like kind of the worst case scenario. And when the volume comes in, that's when the short covering is starting to interact. Or maybe positional buys. I'm not so sure. This is a 50-50. I think you know where I'm going to go on this, much like we did last time. Plus R is off the table. We know that. Is it equals R or is it minus R? And you know what I'm going to do. I'm going to go, no, I can't even be equals R. Let's do 2 more and then we'll adjourn for the day. We've got Richard with NXL and NXT, but I fear they're going to be very similar charts. And I'm guessing now, maybe I've been presumptuous. Maybe some of you are asking about these for shorts. Well, I've kind of answered that questions with my minus R bias. And, it's not the case of, well, Carl, I found you a little bit late in my life, mate. So actually, no, I'm still holding this stuff. Can you give me some hope that it's going back up? Some hope. This is good. This is very strong. That's very strong. And it's accompanied very well here. Okay, so that's impressive. Where did it stop? It stopped here. No surprise. This is a bit more of a pullback than I would like, but it's being saved by this and the fact that that's light green. This is the big elephant in the room. Nice. I mean, do you want to muck around? Don't muck around with the long-term trend ribbon, right? So this has still got a bit of work before it gets to plus R. We know that, right? There's no plus R here for me. But this will be an interesting one because not that I would own it. You know I can't own this stuff. But I think we can do that on this one for now. Where does that change? Beneath here, we're in big trouble again. Okay, one more and then we're done. S32. This one is from Angela. Hello, Angela. Look, this is a good one to do because it's early stage in rolling over, and it's pretty indicative of many of these big resources companies which had a run, which it probably should have been the theme of the day, but we went elsewhere. That's okay. We went to beaten down technology and medical stocks, didn't we? But a far more interesting, we can't go for another an hour, but a far more interesting session, okay, I'm going to do it anyway. We're going to go over for about 10 minutes. We need to do BHP. We need to do Rio Tinto. We need to do South 32. Thumbs up, keep going and address those three. Or Carl, I don't care about those. Just end it right now. Okay, okay, let's go. Let's start with S32 because that's, and we'll do Sandfire and maybe Fortescue. All right, let's, well, I was going to say let's get rid of the old stuff and do new analysis, but at the end of the day, previous analysis, well, there you go. Look at what previous analysis suggested, minus R on that candle, and then beneath here, ZRP, and we're not actually there yet. Let's delete all status and start fresh. Because certainly here, it was actually starting to look good again. I mean, plus R on that day, no, I can't go plus R on that day because this is too powerful. This is not something I want to muck around with. So hard to go plus R on that day. If you went plus on that day, no objections, but I think it's a bit line ball, okay? From there, what happened? Here. I think it's pretty clear cut, isn't it? So falling peaks and falling troughs. We took out this point of demand. We're trading beneath it right now. So that is point of demand, minus R for that one. Close beneath the short-term trend ribbon, minus R for that one. Short-term trend ribbon has changed colour, lower peaks, so we've got the lower peaks and troughs as well. It's not just the fact we've broken the point of demand, but we've got the lower peaks and troughs. I'm going to go three minus R's on this one, and I can see a case for the cheeky plus 100 here. All right. Where would that change? I don't think I can really, an emphatic close beneath here, black candle, full black candle close beneath there. That's even then. I can't even give it that much room. The only reason why I'm saying it is before the calamity that has befallen us, geez, they were buying the hell out of this thing. And them's the break sometimes. Let's go to BHP, the big one. Now, this is a fantastic chart because it illustrates 100% that you can't know what's going to happen next. And on that day there, I'm a buyer. I'm not an equals R. I'm a happy plus R. Buy it, buy some more. Happy to. And then that day comes in and I'm still happy to hold. I'm not buying on that day, obviously, but there's absolutely no reason, based upon my model, to sell anything on that day. I know we've got elevated volume, but it's all good volume. I know we've got elevated volatility, but it's good volatility. It's upside volatility. We've got elevated volume, but there's nothing to worry. Yes, there's a bit of interest coming in on the sell side, but it's small compared to everything else. On that day, I'm going to argue it's just a pullback. It's just a pull. I know there's a gap and run. I know when you blend these two candles together, it's a big black one, but it's still a monster. This has got my attention though. This is the key to blending candles, or this is the key to being able to blend candles. Again, looking past the surface of the chart, these two candles are a big black candle that have engulfed this, and this. So it's got my attention. Would I get out on that day? Heart of hearts, no. I think I just want to see confirmation. That's all. Give me, even if I give up another buck, like it's BHP, it's had a great run. I want to see it go to $70. Let me just get one more candle and see how that plays out. Oh, all right. Let me get one more candle. That's not terrible. Bit of a white day. It was still down. It's coming to the short-term trend. Let me just, come on. Give me some decisive. Okay. Well, there's my decisive call. I can't. I know it's got a downward pointing shadow, but I kind of can't let it go any further. I have to at least get fire the first one away. And this shows how difficult it is. Now, some of you are going, Carl, oh man, I went already. I went 60, 58, I'm gone. What are you doing? I'm just telling you how I would have done it. That candle there, yes, it's big. Yes, it's black, blending, but it's a monster uptrend. This candle, it stayed wide. If that went black, I probably would have done it after that day. This day, big gap. This looks like a good day, but it's not, because you got to look at the true range. You look at the optimized true range. That is a black candle. Okay, I can't give it any more room. Minus A, it's still above the short-term trend ribbon. It hasn't printed a lower peak. It hasn't taken out the last trough. Ugh. And this is where you feel like you're getting hammered, because you didn't have enough advance warning to be able to take these steps. In fact, that day, not only is this a big black candle, again, if you're not seeing this as a black candle, you need to, because this gap is black. This gap is black. This gap is black, right? So for me, I think it's a minus R here. Possibility for a cheeky 100. But yeah, this is the day I have to be out. Now, you might say, Carl, it's rallied since then, and if you got out at the end of that day or the start of that day, let's call it 50-50 as your exit price. Devastating. Devastating. I just, as a trend follower, you're going to have these occasions where you give up a big whack of trend. Why? Because two countries just invaded another country, and that country started throwing missiles at everybody around them. Okay, that's going to happen. Not more often than not, but it will. Is it fair to say more often than not, we got lots of signals to get out early? It didn't happen here. Carl, it's BHP. Mate, I'm never selling my BHP. Mate, you're kidding, aren't you? Okay, fine, no worries. What I'm worried about is this. Okay, that short-term trend ribbon stops acting as a zone of dynamic demand and starts, well, it probably hasn't done it very recently, but when BHP's in a downtrend, it's not that often, but it does. If that short-term trend ribbon starts to act as a zone of dynamic supply, we could have some issues. Anyway, I've told you what I am on BHP, and that is blasphemy for many, I know, because Carl, how could you ever sell BHP? And the answer is, I don't know what's going to happen next. That's why I have to sell it. I'm a trend follower. If the trend's broken, I can't be on it. You do what you got to do. Rio Tinto, I'd say even less warning. But less severe perhaps. Look, the only thing we had here was that, and even then we didn't get it until this day here that we actually closed. Maybe that day was. Yeah, I'm similar here. Without a doubt, minus R. Question mark on the third. And if I can't give you definitive answers, I think you know why. Okay, let's go that. That one's tougher, less damage done, but we're still beneath here. So short-term trend ribbon, the candles aren't that bad. Like the BHP candles were bad. You fill in those gaps black, they were bad. Here, actually the candles are like, there's still accumulation even on the way down. But we're beneath here. And yeah, it's disturbing. I'm sorry if I don't have all the answers for you every time. Fortescue, we've actually done some work on, and you can see in previous webinars we've gone minus R there. So actually Fortescue was the easiest one of all of them, because we actually wouldn't have been holding Fortescue into this mess. I won't do any analysis on that. I don't need to. SFR is where I'll end it. I think we're going to see a very similar situation. However, I would put to you that that's the candle there. That is compulsory. Do not pass go. Do not collect $200. Well, collect some money because you're getting out, hopefully, of a nice profit up to that point. That is a minus R. That is akin to a species-ending event. Big black candle. So massive volatility accompanied by massive volume. The supply has been found. Okay, we want the share price going up on low volume. I know your charts should be going up. Your stock should be going up on increasing volume because that indicates more buying. Like, did you even think about those words before you typed them on the page or you said them out loud? Increasing volume is increasing selling, dum-dum. Yeah, it's increasing demand, but it's also increasing selling. Your stock's going up and increasing selling. Why more and more people want to get out? No, you want your stock to go up on as little volume as possible. And when the volume appears, that's usually not good, right? You've just found supply. So yeah, I would argue Sandfire probably less than a full risk position before this downturn, but equally now, if you were a cheeky 100, maybe, but there's also a pretty strong argument for ZRP or pretty close to it. I wish, ladies and gentlemen, that we had better or happier reasons to be discussing technical analysis today. But, this is the best time to learn your craft. You cannot get a better time to learn about technical analysis trading and really your place in the whole process than what we're experiencing. So, look at it that way. I call it the learning tax. At some stage, you've got to pay a tax to learn. And that's really all the last couple of weeks should amount to. If you stick with it. If you want those trend ribbons, hopefully you agree that they do a pretty decent job. I know there's well over 1,000 people that have requested them. And hopefully of those well over 1,000 people, you're enjoying using them. They're free on TradingView. I share them with you. You need to fill out the form in the recording of the YouTube. Don't worry, the Google form won't raid your bank account. Just put in your name, your email address. Important to fill those out. Otherwise, I won't give you access if I don't have them. And your TradingView username. Some people don't have a TradingView account yet. Don't just put something random in that field. Please go get the account first. Basic account, it's the free account, is perfectly sufficient to view the trend ribbons, and then put your username in. For people who are watching me on YouTube, make sure you hit the thumbs up button, make sure you subscribe, make sure you share this video with your friends, because I know that some other investors out there that would probably get some benefit out of consuming this sort of information. Apart from that, ladies and gentlemen, it has been an absolute pleasure chatting with you today. Sorry, we went a little bit over time, but hopefully it was worth your while. All the best for your trading and investing. Until we catch up again, bye-bye for now.